It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Welcome to INR Bonds Search for Yields. I am Nikhil, and in today's topic, I'll be discussing on how to construct a Goldilocks portfolio, given the central banks are hiking interest rates aggressively, and also the inflationary pressures are mounting. Goldilocks portfolio is a combination of investment into the gold and as well as a corporate bond. So if the portfolio will help the investor to reap the benefits from the rising gold prices, and also will shield if the gold prices fall through the coupon payments from the corporate bond. From the latest RBI policy meeting, which was out of the blue, RBI came out and hiked interest rates by 40 basis points and also stated that the inflationary prices are high. And the same with the Fed. The Fed hiked interest rates by 50 basis points, which is in line with the market expectations, and also said that the inflationary pressures are high. But however, the Fed is unlikely to do a very aggressive interest rate hikes as much as 75 basis points, which helped the dollar index to cool off from the 2 decades highs of 104 levels. And also the US Treasury yields came down to 2.92% from 3% levels. So the rising commodity prices could create a sharp rise in trade deficits for the countries which are importing goods and services. And also, given this uncertainty kind of scenario, the gold has a very favorable spot. And globally, the investors see gold as a safe haven asset during the time of uncertainty, and also perfect hedge against the rising inflation levels. In this slide, we have taken the 5 scenarios, where the first 3 scenarios we have taken the gold price rising by 25%, 50%, and 100% respectively. And the last 2 scenarios where we have taken gold price falling by 25% and 50%. And we have analyzed the gold prices in order to match the corporate bond yields. The corporate bond yields are also analyzed. We have taken a 2.5-year maturity corporate bond yielding 8.5%. So in the first scenario, if you see the gold prices are rising and also the corporate bond yields are around 8.5%. The yield for the total annualized returns are also positive. So here the weights we have taken 30% and 70%, and it's completely up to you and as per your financial advisor or your risk appetite. This is for just illustration purpose. And in the last 2 scenarios, if you see, even if the gold prices fall by 25% or 50%, the total returns in the whole portfolio are positive. Since the coupon payments from the corporate bond will shield against the fall in gold prices. And the first 3 scenarios, the yields of the portfolio are still beating the inflation levels, and also the post-tax also it would be more than 6%, closely beating the inflation. Here, the investment into gold is suggested to digitally than buying the physical gold. The gold ETFs offer a good liquidity for investors, and as well as it is backed by the 100% purity of gold. And for the corporate bonds, you can check on our QuickInvest by INR Bonds app, which is available on both iOS and the Play Store. You can use the filters in order to set the yield levels and as well as the maturity levels. You can choose the bond as per your risk appetite. So the whole portfolio, the combination of the gold and the corporate bond will give you a decent returns and also shield you against the falling gold prices.